This is where the money printing comes in. Pushing money into the system. Well, inflation is when the value of your dollars just doesn't go as far. It is simply defined as more dollars chasing less product. Right now, the price of lumber. And you can see, we just don't have as much lumber in circulation, and the price of lumber is going up. Okay, now there are a couple of different ways that inflation happens. One is just that there's actual undersupply. Just there's some sort of fallout in the industry. The price for the product is too low. The other way is that the government starts injecting so much money into the system. And so now the prices naturally go up. What this does is it devalues savings. This means that your money that was in the bank, it is not worth as much money. It's supposed to spur spending, but this can create an inflationary cycle because now you want to take all your money out of the bank and spend it before it is worth nothing. What you are really doing is taking savings and making them worthless. This is why you see all these pictures from Weimar Germany of people wheeling around wheelbarrows full of cash. Now, we don't do that anymore. You're not going to see people wheeling around wheelbarrows filled with $1 million bills that they just kind of are wallpapering with. So the basic theory is that some inflation is not only natural, but good. In the normal way that an inflation curve looks, it looks like kind of a wave. Okay, Milton Friedman suggested that you wanted to basically look for about a 2% inflation rate. In order so that people didn't take all their money and put it in the bank, you wanted there to be a little bit of inflation so that people would continue to spend and put money into the economy. Sometimes the demand for a product outstrips the supply, so prices go up. But in a functioning free market economy, that increased pricing will actually drive people to enter the business and increase supply so the prices drop back down. There are basically two different departments of the government that are designed to control inflation. One is the Treasury Department, and one is the Fed. The Treasury Department actually prints the dollars, but typically that's not how inflation works. The Federal Reserve, these are the guys who are really in charge. The Federal Reserve controls how much money banks are required to hold in reserve every night. So you've seen the movie Mary Poppins.
Mary Poppins.
Remember how there's a run on the bank. But everybody goes and wants their money out of the bank at the same time. The bank doesn't have the money, they have to close their doors. So what happens if a bank gets to the end of the day and it hasn't held enough money in reserve? Well, then at the end of the day, they borrow from another bank at interest. That interest rate is what we call the Fed fund rate. The Fed sets the rate. They buy or sell securities from the member bank. So here's the bank down here. The Fed will go to the bank and give the bank credit going that way, and the bank will give the Fed securities. All a security is, all a bond is basically a promise that I will give you money right now and you will return that money to me with interest. Since last March, the Fed's fund rate has been at 0, which means easy money. Basically, the Fed is just allowing banks to take money out from the Fed at 0% interest, and then the banks are charging you really low interest rates. If you're wondering why it is that your home mortgage rates on the market right now are really low, that is the reason. It's because the Feds are basically making it super easy for banks to lend to you. Okay, the second way that the Fed manipulates the currency is through open markets operation. The Fed will buy lots of securities from the member banks and then give them credit. Same kind of thing that we saw before, right? Here's the banks. The Fed will send them all sorts of money. They will buy all sorts of securities from them at 0%. And then they just keep giving them credit, right? More and more and more money. More and more money, right? We're just going to shovel money into the banks, right? This is what the Fed is doing. So where exactly did the Fed come up with all of this credit? Nowhere. The answer is nowhere. They just make it up. It's all electronic, so no dollars are actually created physically. When the Fed does a lot of this is called quantitative easing. We saw a lot of this during the last recession. We're seeing a lot of this during this current recovery and recession. The federal government sells these bonds. If the market is soft and the government needs to spend money, the Federal Reserve will simply buy those treasuries from the primary dealers, right? So the question is, where are the banks coming up with these securities? The answer is that the Treasury Department plays a shell game. The Treasury is selling to primary dealers, these banks, and then those dealers are passing those up the food chain to the Fed, and they're getting cash in return. The Treasury Department may have to pay back the bonds one day, but the Federal Reserve has injected cash into the system via the Treasury Department. So here's where we are right now. Inflation is setting in, thanks to both the Federal Reserve's inflationary monetary policy and the Biden administration's massive spending binge, which is funded by the national debt. Remember, when the Biden administration sends out checks, it is sending them out via the Treasury Department. The way the Treasury Department gets its money is the Treasury Department sells bonds. Who's buying the bonds? The banks. Who's buying from the banks? The Fed, right? Sometimes it's coming from foreign sources. Sometimes these bonds are going out to China, right? And that creates national debt. Sometimes the bonds are going out to you directly. But if you really need to inject a lot of cash super fast, what you do is you sell them to these primary dealers, which very often are the banks, and then those get passed up along to the Fed. Right now, the Federal Reserve is holding nearly $7 trillion in bonds. These are securities, mortgage-backed securities, other assets. Presumably, at some point, the bonds and securities will indeed have to be paid off. Right now, the Fed is owed a bunch of money by the Treasury Department. The good news is this is where the money printing comes in. Who's got the printing press? These guys got the printing press, right? In the meantime, the Federal Reserve has run out of stimulus tools. You've got inflation, which is you've got the pricing going like this, and demand, instead of coming up to meet it, which would drive this down on the other side, supply and demand curves are supposed to look kind of like that. Instead, the supply curve is going to go like this. And what happens with the prices? They're going to continue to go this way as long as the government pushes it. So this is when you get stagflation. Now, the problem is the entire theory of inflation from the Federal Reserve is that the way that you stimulate demand is by giving people more money. If they have more money, they have more money to spend. But what happens when the demand isn't there? Because people have decided they're going to take the money and they're going to put it in the bank because they don't trust that their dollar is worth anything. So no matter how fast they spend, they can't keep up with the inflation rate and they don't have a job. So what exactly happens at that point? Well, that is when the pain sets in. Because at a certain point, the Federal Reserve has no more tools. When they're already at zero, what do? In Europe, they've actually tried to go to negative interest rates, which is kind of crazy. That is literally the Federal Reserve paying the banks to take the money, right? You could try it. You can't do it forever. Inflationary cycles with stagnation are generally breakable only through pain. And given the current inflation rates, pain could set in a lot sooner than we expect. I'll be honest with you. I thought that the natural economic recovery that was set to happen after COVID was going to last at least a couple years, and it would take a little while for Joe Biden's crappy monetary policy to catch up with us. Instead, we're getting record inflation rates, like the worst inflation that we've seen in 40 years. It's pretty astonishing how fast all the bad policy caught up to Americans. Janet Yellen, who's the Treasury Secretary, she keeps saying that inflation is just going to cool off. So what they really hope happens is that this follows the normal rules of supply and demand. That, yeah, we're inflating the currency, and yeah, there's a little bit of a hold up here, but eventually supply is going to go up to meet it, and then you'll get the normal supply demand curve, right? Then you'll get you'll get this. The problem is that there's no guarantee that that happens, especially because of the artificial shortage of labor that is being created here. It means this line is not happening right now. The inflation rate this month was something like 4%. Well, normally, if you can ramp up supply to meet that 4% inflation rate, okay, this is going to go down again. And that's sort of what Janet Yellen and company are suggesting. And they're saying, okay, well, if we have to, then we'll raise interest rates and we'll start to suck money out of the economy, and maybe that'll bring down the inflation rate a little bit. But the problem is there are two numbers that matter. One is the 4%. The other is the 266,000 jobs that were created last month. Okay, that was supposed to be 1 million jobs. Okay, this gap is really devastating. What it shows is that even though we are blowing money into the economy, and in some ways because we are blowing money into the economy, specifically by paying people to stay home, there is this gap between the ability to ramp up the supply to meet the demand. And that's how you end up with stagflationary cycles. What is the long-term solution to this? I mean, the truth is that the long-term solution to this is a gold standard, right? The long-term solution is what we abandoned a long time ago. The abandonment of the gold standard was a way for government to take control of the monetary supply. And the disconnecting of the American currency from the gold standard and from international gold rates, when that happened, we completely disconnected the dollar from anything. It is not connected to anything except the full faith and credit of the United States. So whatever the hell that is worth.
All men and women created by you know the thing.
The real answer would be, some sort of asset that is disconnected from the ability of governments to manipulate the currency, which is why you are seeing rising prices of Bitcoin. This is the reason you are seeing that. There are two theories of what happened during the Depression. One is that the Federal Reserve created too loose a monetary policy. This is sort of the Vienna School of Economics. They say that there was a stagflationary cycle that set in, basically, where the Federal Reserve had blown too much money into the economy. There was too much speculation on the basis of crappy assets, and the bottom fell out of those assets. And then there was a bunch of follow-on legislation from the federal government that really made things a lot worse. There's trade legislation that killed international trade. There's high taxation rates, high spending rates, and that really exacerbated what should have been a short-term sort of depression. Then there is the the Milton Friedman Chicago School of Economics, and they say almost precisely the opposite. They say that the monetary supply was too tight, and that what happened is when the Depression hit and stocks lost a lot of their value, banks should have immediately been pushing money back into the system, that there wasn't enough money that was being pushed into the system. So there's a bunch of different arguments about exactly what happened during the Depression, and they have almost precisely reverse consequences. What is generally agreed on by free market economists is that the government coming in, raising tax rates, removing capital from the system on behalf of government spending, and raising tariffs was a disastrous decision. It's hard to know whether we're heading to a full-on Great Depression at this point. I mean, right now, obviously, the job market continues to grow. What is certain is that things are not going the way that we were told they were going to go. And so that means that we have a couple of different paths here. One is you enter a stagflationary cycle that looks a lot like the late 1970s, with randomly high unemployment and very, very high inflation rates, with savings that are basically becoming devalued over time. The other one is that you do get a full-on depression in which people basically sell off their assets. But I don't really see that happening in an inflationary cycle this way. That seems hard to imagine. And the other is that maybe we just come out of this. And that's sort of what Joe Biden is hoping at this point. There may be some whistling past the graveyard because, again, these inflation rates are much higher than we were told they were going to be.